Welcome back to Strongman Personal Finance. Welcome back, everybody. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. It's a lot cheaper than this guy's Discord. And I'm a hater of Jeremy Lafifi. And he actually does a rear in this video. A rear! It's pretty funny. You'll see. Now, today, we're going to look more into Jeremy's stock analysis philosophy and why he's a total freaking moron that you should not be paying hundreds or thousands of dollars to get access to his knowledge. Now, in this video, he's talking about a penny stock. And can you guess which one that is? It was on the title of this video. Very Good Food Company. Now, we all know what happened to Very Good Food Company. It got freaking decimated. It's got to be 50 cents or less by now. We'll go check. But in this video, we're going to listen to why Lafufu was bullish on this stock. And we're going to rip him apart. So let's go ahead and listen to why he liked this stock going back in, what was this, April 27th, 2021?
Okay, so I just want to cover that first. Alrighty, so let's get into some of these numbers. So 2020 revenue growth increased 364% to $4.6 million compared to the prior year. Adjusted gross profit in 2020 increased to 32% compared to 16% in 2019. Significant increase in production capacity, e-commerce sales, and distribution partnerships drive continued operational and financial growth. Okay, these numbers.
Now, one thing you'll notice about his videos, he never talks about profitability. It's always about revenue growth. And in this one, he actually talked about gross profit, which is at the top of the income statement, okay? There's a lot of other expenses that a company has besides the cost of the goods that it sells. If you want to actually value a company or do a discounted cash flow, you should probably look at the free cash flow and maybe even the bottom line profitability on a GAAP basis of accounting. No, that's impossible, strong man. The only thing that matters is revenue. So let's fast forward a little bit, and you'll see he just talks incessantly about freaking revenue. That's all he seems to care about.
Extremely bullish on, okay? Extremely bullish on.
Sure
Look at this, okay? Revenue increased 364% to $4.6 million in fiscal 2020 compared to just under $1 million last year, okay? In Q4, revenue, they did $1.8 million compared to $1.3 million in the previous quarter, okay? Look at that. That's crazy, okay?
It's crazy.
Q4, they do 1.8 mil. In all of 2019, they did 999,000. So they did over a double up. A
2x
of basically their earlier year numbers just in a 3-month span.
All right, so let's look at this. Okay, top bullet, revenue. Next bullet, e-commerce sales. That's revenue. And wholesale revenue. Revenue. Where's the profits, Lafufu? I want to hear about the freaking profits. That doesn't matter. Now, when you buy a stock like this, and we're going to look at the financials, we'll actually go look and we'll see why he had a massive flaw in his reasoning. If you look at a company like this, you can't just value it based on revenue. I mean, the only way you can value it, I guess the only way you can value it is freaking revenue, because it's losing so much freaking money. If you're losing massive amounts of money, you're burning cash left and right, there's nothing fundamentally holding up a stock like this, okay? It's all hope and wishes and, oh, it's future, bro. That's the only thing that keeps up stocks like this. And if people lose confidence in this company, and it could happen at any time, the stock gets freaking crushed because there's no underpinning fundamentals. You have to understand this when you listen to freaking clowns like this. But in his mind, revenue went up, and that's the only thing that freaking matters. And you'll see that he got devastated because of this. Now, let's go forward a little bit more. I think he does like a scream somewhere, but I don't want to do too much. I don't want to spend too much time in this video listening for him to go.
6 figures on the position as of right now.
All right, so here's how much he's put into the stock. So he bought it at $148. That's his cost basis. Maybe he got average into it. And he invested $59,000. And he made $100,000 in returns. Now, if you see this, you're like, oh my God, that's a massive return. This guy must be a freaking genius. Well, guess what? He definitely does not have that return now because he bought a trash company. If you buy a penny stock, yeah, you might see these massive fluctuations, but you could also lose your butt just as fast if anything negative comes out about the company. Now, what happened is, I believe in October, and he actually talks about it in this video right here, they decided to dilute the shareholders, which means the company, Very Good Food Company, issued a bunch of new stock. What that means is they're splitting the ownership of the company over more and more and more people, which means your share of the company's future profits goes down. So here's Jeremy in his car on October 15th, 2021. He filmed this original video in April. Now it's October 15th. He's sitting in his car complaining because Very Good Food Company diluted the shareholders. And I'm going to show you exactly why they did it.
That one passed. But then today, they decide they're going to dilute the shareholder base in a massive way. An absolutely massive way. Just completely dilute us to the ground. I don't know if it was a 10, 15% dilution. The number was huge. It was ridiculous. To raise $30 million. What? Out of nowhere.
Out of nowhere. Keep that in mind.
It makes sense to raise money in two scenarios. Two scenarios it makes sense to raise money. If a company's in a situation where they're absolutely super desperate for money, it makes sense to raise money. Like if you're
they were desperate for money, as you'll see in a second.
really, really desperate, you're clinging on for life, yeah, raise money. Do what you got to do to, survive another day, okay? That makes sense if that was the situation the company's in. The company's not in that situation.
They're not? We'll go look at the financials in a second.
Or you're in a situation where the stock price is flying high. If the stock price is flying high, raise money. You know what I mean? Like, it can make sense. Like, you don't get those opportunities very often, right? So
so here he is freaking complaining about Very Good Food Company diluting the shareholders. So they issued a bunch of stock. Now, I actually pulled up the financials that for the month ended, or for I guess the quarter ended, September 30th, 2021. Now, if you look here, they have cash and cash equivalents of $10.5 million, and they have accounts receivable of $1.6 million. Now, you can add, inventory and prepaids are current assets that are going to be, expended within a year. But inventory is not liquid, okay? Neither are prepaids and deposits. So if you want to finance your company, you're basically looking at cash and cash equivalents, accounts receivable, and marketable securities. Those are things that you can quickly turn into cash or already are cash in the event, or in the example of cash, to pay off short-term debts. So they roughly had, we'll say $12 million of cash as of September 30th, 2021. Now, let's go look at the statement of cash flows, because there you can see how quickly they're burning freaking cash. And when I saw this, I was like, holy freaking crap. So if you look here, there's two places you want to look. There's net cash provided by operating activities, or spent in operating activities, and then net cash used in investing activities. Operating activities are what you do to run your business. You're buying in inventory, you're selling inventory, you're collecting accounts receivable, you're paying bills. That's cash used or received from operations. And then investing activities is buying and selling capital assets, baby. Property, plant, equipment, stuff like that. So you look, and for the 9 months ended September 30th, 2021, we'll see how much freaking cash they burned. So, they burned $22,455,423 over 9 months. They burned $22 million just from their operations. And then they spent $12,936,900 in capital expenditures, investing activities. So over 9 months, they burned $35 million. So if you divide that by 9, you roughly get a cash burn of just under $4 million. So if you go back up to the balance sheet, you can see that they only have $10 million of cash equivalents, and $1.6 million of accounts receivable. And maybe the company was burning even more cash in October, and they decided, hey, we roughly have 2 or 3 months of cash that we can use to spend it on, on our operations. before we completely run out of money. That's why they issued more shares. They were burning roughly $4 million of cash a month, and they had $10 million of cash on the balance sheet and $1.6 million of receivables. Oh my God, I'm so shocked they issued money. So when you look at a statement of cash flows, you have to look and see how much cash are they burning or receiving. In this case, they're just burning cash like crazy. And if they're burning cash from operations and they're burning cash from investing activities, the only way they can raise money is financing activities. I mean, they could sell capital assets, which isn't a good thing for the business, but basically the main way you can make money is issuing stock, okay? Here you can see they raised $18 million from issuing stock, warrants, stock options, blah, 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 blah. So, I am not in the least surprised that they freaking diluted the shareholders. And it doesn't take a lot of financial education, to know that looking at a statement of cash flows, that they're burning money like freaking crazy, okay? And if they're doing that, they're going to have to raise money by issuing shares or issuing debt. So, here he is complaining, oh my God, they diluted us. I wasn't shocked in the freaking slightest. As a matter of fact, I laughed super hard when this happened. So never forget. Oh, here's Crane Man 87. Jeremy's on his way to the truck stop. Oh, I love it. I freaking love it. So let's see what Very Good Food Company's doing now. Jeremy had a cost basis of 147 and it's now 53 cents. So 53 minus, I think it was 147, 148 divided by, what was it, 148? So he's down 64% if he didn't sell the stock. I don't know what he freaking did with it, but that's what happens when you put your money in companies that are bleeding cash like crazy and you only look at revenue. It's stupid. Anyway, that's it. Like, subscribe, tell your friends about me. Never forget that Jeremy LaFufu was pumping Very Good Food Company. It's future, the revenue! And he probably screwed a lot of people. And he was shocked, even though he's such a genius with investing. You couldn't read a simple statement of cash flows. He was shocked that they diluted the shareholders. Alright, talk to you later. Chew!